Bismillahirrahmanirrahim. Welcome dear students at the fourth year English section. Today we will talk about financial analysis and financial ratios. First, true or false questions. First question: ratios are used to compare different firms in the same industry. The answer is true. Ratios analysis provides a meaningful comparison of a company to its industry. Second, ratios are not considered as important to non-accounting functional areas of a business such as marketing, head of production, and human resources. This is false, where ratios are so important for all departments in the company. Third question: asset utilization ratios include receivable turnover, average collection period, inventory turnover, fixed asset turnover, and total assets turnover. This is true. They are the financial ratios concerning asset utilization. Question number 4. Financial ratios are used to weight and evaluate the operational performance of the firm. This is true. With using financial ratios, we can see whether the operational performance in the right track or not for the company. The fifth question: liquidity ratios indicate how fast a firm can generate cash to pay bills. This is true. Where liquidity ratios concerning mainly with the ability of the firm to pay its obligations. The next question: asset utilization ratios describe how capital is being utilized to buy assets. This is false. Measure speed. Asset utilization ratios measure speed at which firm turns over accounts receivable, inventory, or long-term assets. Accounts receivable turnover, inventory turnover, or long-term assets turnover. Seventh question: profitability ratios allow one to measure the ability of the firm to earn an adequate profit compared to sales, total assets, and invested capital. This is true. Next question: asset utilization ratios measure the net returns on various assets, such as return on total assets. This is false. A trade creditor is most concerned about a firm's profitability ratios. This is false. Here we can classify the categories of persons that concerned with financial ratios into three main categories. First, potential investors. Second, bankers. Third, creditors. Creditors mainly focus on debt utilization ratios. The main concern for creditors is debt utilization ratios. where potential investors mainly focus on profitability ratios. On the other side, bankers mainly focus on liquidity ratios. The next question. Ratios are only useful for those areas of business that involve investment decisions. That's false. Debt utilization ratios are used to evaluate the firm's debt position with regard to its assets base and earning power. This is true. The DuPont system of analysis emphasis on profit generated by assets can be derived by a combination of profit levels and how fast an assets can turn over. This is true. The DuPont system of analysis identifies the true sources of return on assets and return on stockholders. Next question. Satisfactory return on assets may be achieved through high profit margins or rapid turnover of assets, but not a combination of both. That is false. Return on assets could be satisfactory, achieved through high profit margins or rapid turnover of assets, or both, a combination of both. The next question. Heavy use of long-term debt can be of benefit. Pay attention, long-term debt can be of benefit to a firm to help expand, although it adds to the firm's overall level of risk. This is true. Return on equity will be higher than return on assets if there is higher amounts of debt in the capital structure. This is true. Next question. Return on equity will not change if the firm increases its use of debt. This is false. Return on equity will be changed if the firm increases its use of debt. The age of the firm's assets is not necessary for analyzing ratios. This is false. Where reported income must be further evaluated to identify sources of distortion. The next question. Asset utilization ratios relate balance sheet assets to income statement net income. This is false. To compute the quick ratio, accounts receivable are not included in current assets. To compute the quick ratio, accounts receivable are not included in current assets. This is false. Multiple choice questions. First question. Ratio analysis can be useful for historical trend analysis within a firm, comparison of ratios within a single industry, measuring the effects of debt or equity financing, or all of the options are true. The answer is D. All these points are true. Trend analysis shows companies' performance over time. So, ratio analysis provides a meaningful comparison of the company to its industry as a benchmark or criteria that could be compared with it. Second question, examining the liquidity ratios, the primary emphasis is the firm's A. Ability to effectively employ its resources. B. Overall debt position. C. Ability to pay short-term obligations on time. Or D. Ability to earn an adequate return of or profits. The answer is C. The ability to pay short-term obligations on time or on the due time. Third question, which of the following is not an asset utilization ratio? Inventory turnover, return on assets, fixed asset turnover, average collection period. The answer is B, return on assets. Fourth question, which of the following is not a debt utilization ratio? Is not a debt utilization ratio. Debt to total assets times interest earned, fixed assets turnover, fixed charge coverage. The answer is C, fixed assets turnover. Fifth question, a short-term creditor would be most interested in. Here, the focus of creditors. A. Profitability ratios. B. Asset utilization ratios. C. Liquidity ratios. Or D. Debt utilization ratios. The answer is C. Liquidity ratios. We said earlier, the focus of creditors is on debt utilization ratios. The liquidity ratios will be the most important thing for bankers. The potential investors will focus on profitability ratios. So, short-term creditors will be most interested in liquidity ratios. The next question, which of the following is not considered to be a profitability ratio? Profit margin ratio, times interest earned ratio, return on equity ratios, or return on assets or investment ratio. The answer is B, times interest earned. Which two ratios are used in the DuPont system to create return on assets? To create return on assets, we use two ratios: return on assets and asset turnover, profit margin and asset turnover, return on total capital and profit margin, or inventory turnover and return on fixed assets. The answer is B, profit margin ratio and asset turnover ratio. The DuPont system of analysis identifies the true sources of return on assets and return to stockholders. The next question. The Golden Corporation had earnings before tax of 400,000 and sales of 2 million. If it is the 40% tax bracket, its after-tax profit margin is, simply speaking, we can use the equation or profit margin ratio equal net income divided by sales. We will compute simply, it will get us 0.12. So the answer is B, the profit margin, again, equal net income divided by sales. The next question. A firm has a debt to equity ratio of 40%, a debit of 250,000 and a net income of 100,000. The return on equity is return on equity. We can compute it simply. Return on equity equal net income divided by stockholders' equity. So debit divided by equity equal 40% or 0.4. So equity equal 625,000. Using this number in the return on equity equation, so net income divided by stockholders' equity. Net income 100,000 divided by the equity number, that's 625,000. It will give us 0.16. So the return on equity equal 0.16. Next question. A firm has a debit to total assets ratio of 60%, 300,000 in debit, and a net income of 50,000. Calculate return on equity. Return on equity equal return on assets divided by 1 minus debit divided by assets. So debit to total assets equal total debit divided by total assets. Pay attention. So 60% or 0.6 equal 300,000 divided by total assets. So total assets equal 500,000. Using this number in the second step, we should compute the return on assets. Return on assets or investment equal net income divided by total assets. Net income given 50,000 divided by total assets 500,000 equal 0.1. So simply speaking, we can compute return on equity equal return on asset, that is 0.1 divided by 1 plus